Welcome to Growth TV. I'm Carolyn Vallejo. 2023 ended on a bit of a sour note with the expected fourth quarter M&A rebound never quite materializing. Here to offer their insights on Q4 data and share some of the surprising highlights are Scott Linch, National Industry Leader of Private Equity at FORVIS, and Bob Dunn, Managing Director of GF Data. Bob and Scott, welcome to Growth TV.
Thanks, Carolyn.
Thank you.
So 2023 ended with a bit of a whimper, not really a bang as we had hoped, but smaller deals did seem to be a bright spot. Bob, can you first tell us a little bit about that highlight?
Yeah, just for background, Carolyn, as mentioned, there's a lot of talk about a potential rebound at the end of the year. Didn't materialize. We recorded GF Data recorded 269 transactions for the year that we reported on. That's down about 19% from the tally in 2022 and about 46% off of 2021's total. So we're definitely in a trough on it, notwithstanding that we were in a bit of a boom market coming out of the COVID quarantine period. That said, though, we have seen valuations, average valuation increase across the last 3 quarters. And particularly for smaller transactions, we saw some notable rises on it. Deals valued between $10 million and $25 million recorded a more than half turn of EBITDA improvement in the fourth quarter, reaching an average of 6.6 times trailing 12-month EBITDA compared to 5.9 times trailing 12-month EBITDA for the quarter prior. Similar improvements, though not quite as great for deals 25 to 50 million. But overall, we are seeing valuations starting to perk up, which I think is a positive sign. But really, we're kind of mired in the low deal volume right now.
I would add on to that, while total deal value dollars were down, I mean, there still were a ton of deals that were getting done more on this smaller deal size. And I think for a couple of years now, add-ons have been over 75% of what deals are getting done. And that really is driving deal activity just because those are the types of deals that companies can finance on their own balance sheet with the debt that they already have. And that really allows them to continue to get those deals done. Basically, private equity funds have been kind of this wait and see mode of what's going to happen with interest rates, what's going to happen with inflation. And they've been focused on improving the value of the portfolio companies they own. That can be through add and on businesses or just value creation activities, doing things to make the business run at a higher profitability, therefore to be ready for an exit later on.
Another interesting trend that we did see play out in 2023, and especially in the fourth quarter, was this move towards rollover equity as a way to kind of push deals past the finish line. Bob, could you share a little bit of the data there, as well as some of the ways that you're seeing the lending market impact these PE-backed middle market M&A transactions?
Sure. Yeah, it's interesting. This is particularly happening at the not the small end of the market, but looking at 25 million and above, we saw a notable uptick, as you mentioned, in seller rollover equity. It's averaging about 15 or 16% of the total transaction price at this point, which is up at least 5 or 6 percentage points from last year. I think it speaks to more creativity in the market and trying to get deals done, but definitely highlights that there's a disconnect between valuation on the part of buyers versus sellers. And that the additional rollover equity is potentially a way to sweeten the deal that may not be quite there for the seller's perspective, but gives them a chance to take a second bite of the apple when the next exit comes around in the business.
Yeah, I just would say that creativity is the right way to think about it. I think there's been a lot of different ways that people are going about it, whether it's earnouts, seller paper. You talked about rollover equity. There's also some funds that are traditionally buyout funds that are doing growth equity because they're able to, they want to put the same dollars to work, but they may not be able to do a control deal right now. And then the private credit continues to fill the gap. We're seeing the private credit markets really jump in and help. And then even some of the small SBIC funds that are focused on mezzanine and junior debt solutions, we're definitely seeing a pickup of activity with those funds. Even some warrants in some of the deals that we're seeing. Also just doing things that are creative ways to get capital back, continuation funds or something that we're seeing pick up in activity and probably expect that to continue here this year as private equity funds look to get liquidity for their LPs in a market where they're not really ready to sell the business yet. So just a lot of creative ways that people are thinking about things.
And just to agree with Scott on, I think private credit is really coming to its own at this point. It was obviously there beforehand, but it's definitely the majority of what we're seeing for financings now coming from private credit groups versus traditional banks. So yeah, it's definitely having a huge impact on it. Continuation funds is definitely an interesting one. I think there's a lot of creativity going there to potentially extend the life of a portfolio company to a point when you're really excited about the exit versus having to do it just because you've run out of time on it.
So we're nearing the end of the first quarter of 2024 as we speak. I can't believe it. What is your outlook for the first half of the year now, knowing kind of how Q4 shaped up? Scott, how about you lead us with this one?
Well, Bob, I don't know if I want to go back and watch the videos we've done here before because we probably said it'd be back by now. But it continues to be in this hold strategy of a lot of the portfolio companies. If you see the average life of portfolio companies is extending longer than it probably ever has. But that being said, a lot of funds raised money in that early 2000s, right after COVID. There was a lot of funds being raised that have to be put to use. I think there's over $1 trillion of dry powder, pretty close to that in the U.S. markets. And they got European plus, capital on balance sheets of major corporations. So there's just a lot of cash out there that has to be put to work. And so we really do expect the second half of this year. I'm going to go ahead and say that again. Second half of this year has to be the place where it comes to fruition. I mean, we do see an increasing amount of preparedness for deals, people going to market. So we're seeing an increased number of deals in market. We're definitely seeing buyers call us with 2, 3, 4 different things that they're adding onto a portfolio company when they might have only called us with one in the fourth quarter. So they're definitely picking up the add-on game as well. And so we expect that there will be increased activity. The last point I'll make is that the public markets continue to come back a little bit, the fourth quarter and now. And so when public multiples go up, that does make it more attractive potentially to exit these private companies. And so the valuation gap could be closing on some of that, except for the fact that we got the interest rates to deal with.
Yeah, I would agree with everything that Scott said there. I think there's increasing pressure from LPs to get some returns back from funds, notwithstanding continuation funds and the crop of funds that was raised just prior to the to COVID. But I think the need for exits is definitely going to drive activity. I would concur with Scott. I'm hearing a lot of talk from folks we speak with about prepping businesses and kind of getting ready to go out to market with them. That's always kind of a wait and see game, whether it's going to be this quarter, next quarter, the following quarter. But it does seem like people are quite busy right now. And I would add, we had a roundtable in the fall that had representative from a large middle market private equity firm there. And his point was, we're really not equipped to manage this many portfolio companies in terms of personnel. It's not, they're well above the parameters they normally go for in terms of number of companies that they're operating. So I think there is pressure there, both from the LP side, as well as just the realization that, even if you really like the company and you're not happy with the value you're going to get, you need to get out of some of these things. So hopefully that'll drive more market activity. And I would tend to agree with Scott, probably the second half of 2024 when you look for that to really happen.
Absolutely. So right now it's kind of that phrase that everyone's sick of hearing, which is cautious optimism, but it really seems like that's the name of the game right now.
We were going to use the word optimism.
That's what the tattoo is going to say. But.
Exactly. That's what the tattoo is going to say, cautious optimism. But, we'll have to check in and see next quarter, which of course we will do. So Bob and Scott, thank you so much for joining us again on GrowthTV.
Excellent.
Thank you, Carol.
My pleasure.